Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Chandos Mahon of Castle Capital. Nicholas, what was a takeaway you had from our conversation with Chandos?
So we've gotten to know Chandos over the last year or so by looking at several deals with him. And since this recording, we decided to commit to his latest deal. He hasn't closed it yet, but it's in the waste management space. And we're super excited to be on board as a limited partner with Minds Capital in that deal. I often ask people, even on this podcast, to do an attribution analysis of their returns. So, if they tripled EBITDA or quadrupled the money or whatever they did, I will say break that down, provide a waterfall of where that came from. And very rarely do you get a good breakdown that is MECE, as we say in consulting, mutually exclusive and collectively exhaustive. But Chandos actually gives us one, and it's very exciting. And not only is it fully broken down, but there are only really three major things at work here. So he had a waste management roll-up. They did 14 acquisitions over 7 years and had a fantastic outcome. He talks very elaboratively about it in this episode. And the success was really coming from three sources. One was the arbitrage on the M&A they did. So they would buy a lot of targets in the 4, 5, maybe 6x range. And then they sold, I think, in the a little bit higher single digits range when they exited. I don't know that he said specifically. The second factor was that they identified 2 KPIs, one being quality of service, and the other one being tires per hour. So how many tires, which was the waste they collected, were they able to collect per hour? And upon identifying these KPIs, they really redesigned their whole business, their compensation systems, their operations to maximize those two. And that drove the success of organic growth. So I thought that was just fantastic. The thoroughness in how deep he went on that was fascinating to me. He makes it sound simple, right? When you can boil it down to 3 or 4 factors. So that was cool. One factor he didn't attribute to, which surprised me a little bit, was that they built out a business here that dominated the west side of the country, where there was an 800-pound gorilla in their industry that basically had the rest of the map of the country. And so we asked him, so you built this business specifically to sell to them, which is what they did. But he says that was always an option, but not necessarily something they built specifically towards. But I would have thought that would be a big part of the return journey, but it wasn't necessarily so.
This concept of building with a single acquirer in mind, I feel like we heard kind of that theme here. Nicholas, we heard it in our conversation with Nicholas and Iron Mountain. And I don't know to what degree that actually happens, but it seems like a terrible strategy. I mean, that would be acquirer concentration. No?
Risk. I see the risk you're pointing to, but there are plenty of private equity groups out there who do it successfully, and usually they'll be very industry specific. So you'll have someone who focuses on oil services, and so they'll sell a lot of businesses to Halliburton and SLB and other players in that industry. Their partners have been board members or C-level executives of these companies before, so they know exactly what is their ID and DNA. They know exactly how they think. They know exactly what kind of targets fit into their umbrella. And so it feels less risky. Another example would be we recently chatted with a sponsor where a former C-level executive from one of the biggest airline companies is the independent sponsor. And that's an example of where he can really understand the DNA of that airline and understand better than anyone what the target needs to look like for that particular airline to buy it. It probably works better if there are a small handful of such acquirers versus one in the case of Chandos here. But in general, I believe it. You're building something very specific for a specific customer, and it's not necessarily rocket science. These are huge $100 billion companies and conglomerates. And so if you service their customers or provide value that fits in their portfolio, you don't need to be an insider to see what that means.
I certainly see the logic and how it all can work together, and you can connect the dots going forward about what the outcome would be. But it's just striking to me that, as investors will penalize so harshly, like 20% revenue concentration. And yet the entire outcome of a multi-year project could come down to a single decision within the corporate finance division of a large conglomerate, and we're fine with that risk. So it just doesn't seem commensurate with the enormity of a single decision affecting the outcome of an investment. So my point on the Chandos conversation was for people listening who are not necessarily familiar with the search space. He mentions David Dodson as his mentor. David Dodson is a hallowed name in search land, a search investor, and an author of a book, The Manager's Handbook, I think, which Mark Anderegg, who teaches the ETA course at Tuck at Dartmouth, teaches that from that book as a textbook, I believe. Mark was a guest on Acquiring Minds, mentions David Dodson. Jason Jackson, also a guest on Acquiring Minds, had David as an investor and now works with David at David's firm, Fudalufu Partners. So just for context, for anybody who doesn't know who he is, he's a very big deal. And as Chandos communicates, he was very lucky to have not only David on his board, but David be so involved and so active in the investment and sort of coaching Chandos through it. And David is known for his reverence for KPIs, and you see how Chandos is a student of that, because now, of course, Chandos is as well. Max, what do you think of our conversation with Chandos?
Well, I think I'll just touch on what you both just said, and I'll start with what you just said, Will, about having a board member like David. And I see even in our analysis of deals where sometimes the board can be the needle mover for us on a favorable decision. And often, if that's it, for example, if it's a sponsor and it's their first deal, and we love everything about it, but they don't really have a track record. But all of a sudden, then you look at the board and they've got somebody like David or an industry expert who is a CEO of an airline customer that the company does business with. That can really move the needle in such a major way. So there's a lot of ways to gain that inside experience, industry experience that we're looking for with a sponsor without the sponsor being the direct industry experience. I think you can still get that insight and get those relationships within the industry just by having the right board member. So that's a key part of a lot of these deals where you have a strong board and that can really be a difference maker. And then as you go back to risk associated with a single acquirer, I think that's a really interesting discussion point, Will. And I would just add that it's, in my mind, it's different than customer concentration, because when you have a customer concentration that's excessive, that customer can just end your business with the stroke of a pen. They could not buy from you. They could change the pricing. You might not have any pricing power. They've got such control over you that's inherent in that relationship that it puts your business at a tremendous amount of risk, versus I think when you're looking at exit opportunity concentration, I think that works in certain industries because the incumbent might be like a public company in the case of who Chandos sold to and who he might sell to in his next venture. You can see how that company's performing. You can grab all their financial statements. You can look at their cash position. I mean, all that's publicly available, particularly if it's in an industry that's just absolutely recession-proof like waste. And so you're building a little sub-platform for them. In the case of Chandos, he built it in a market that was adjacent to them that they weren't quite penetrating yet. And then he just became so much of a thorn in their side by taking a big customer in Walmart that they really had no choice but to acquire his company. And you already know what the arbitrage is going to be, because you can look at that, assuming it's a public company, you can look at their stock price and their price to earnings ratio. And if they're trading at an 18 or 20 and they're planning to buy you at 10, I mean, there's a win embedded in that deal for them as well. They buy that revenue, that EBITDA, as small as it might be. They already know what that's worth to them on day one in the public market. So I think I agree. I think in the wrong industry, that's a tremendous risk that needs to be evaluated. But in certain industries where they've already rolled up, the incumbents might be publicly traded, you've got a lot of information on them, I think it's a really good strategy. And I actually like that component of his deal that we're committed to.
Well, I take your point that customer concentration, revenue concentration, if that goes in the wrong, in the way you don't want it to, it can mean the end of the business or seriously impairing and harming the business. Versus acquirer concentration, if you don't get acquired by the juggernaut you were hoping to, it doesn't mean the end of the business. You should still have a strong business that's throwing off EBITDA. So it's more about acquirer concentration is more about upside, the risk of not having, maximizing your return, whereas revenue and customer concentration is more about downside risk mitigation. So they're a little bit talking to different sides of the investment.
And if I could just add one more point to that, because that's another good point that you just brought up. I think you have to look at, can this acquirer actually, do they have any way to sort of put you out of business once you become a thorn in your side? And I think in Chandos's case with these deals that he's talking about, he believes that it's not pricing, that the customer is not deciding who to use necessarily just based on pricing. They're actually willing to pay a little more for better service. And so it's almost like, can that incumbent acquirer come into your market and push you out once you're already embedded there? So basically, they've got to convince your customers, hey, we're this big company with a really kind of bad customer service relationship reputation, but we're going to come into your market, but switch to us, right? Because we're going to give you a discount or something. There's got to be some way to tell that they can't just come in and put you out of business. And I think he was comfortable enough in these deals that service was the differentiator to where he could build a bit of a moat around the business where the acquirer would have to make the acquisition to get access to the market.
Mm-hmm. Well, let's hope he can do the exact same thing again.
Let's hope so.
Well, let's get to the interview now with Chandos. A reminder that at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we average about a commitment per month. So if you're a sponsor raising equity for a platform acquisition, submit your deal to us at our website, mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's also a pre-registration form on our website for accredited investors. You can fill that form out to be kept in the loop on future raises. That is mindscapital.co. And here is the Minds Capital podcast interview with Chandos Mahon. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Chandos Mahon, as a 3-year-old, dreamed of becoming a garbage truck driver. Later in life, Chandos found search to be the perfect bridge between operations and investing. So in 2015, he launched a search fund with an eager eye towards, what else? The waste management industry. He acquired a platform in 2017, which eventually became a roll-up with 14 add-ons. They exited to a strategic in 2024, securing a 5x net MOIC win for their LPs. Very well done, Chandos. He re-entered the game in 2025 last year. Now, as an independent sponsor, Chandos closed a deal a few months ago and is currently fundraising for another buy and build platform in the waste management space. Chandos Mahon, welcome to the Minds Capital Podcast.
Thanks, Will. Glad to be here. You make it sound very glamorous.
Well, now, reincarnated as an independent sponsor, how would you contrast this model with the search fund model, which you were so successful at the first time around?
Yeah, first off, I absolutely love the search model, and I owe the community a great deal of contribution towards the success I had. So so I'm early on as an independent sponsor. I think and the deal we did last year was very much bringing the search community into the deal. So it's we could talk more about that later, but I think the biggest difference that I'm seeing so far between search and independent is management and deal type. So, with the search community, the focus is very much you as the searcher are stepping in to be the CEO, to be the catalyst of how this company grows the next phase, and you're personally taking on that responsibility, whether you're an single searcher or partnership searcher. I think independent sponsor. There's different flavors here, but we're very much looking for a management team to come in and be the catalyst, or a company that has a really good management team that needs help. And I'm not stepping in to be the CEO. So I think that's the biggest difference. And then on a deal structure, I think, on deal type, the search community has very much at a high level a formula of kind of a type of business to be hunting for, and I think that's partly because you're going in as a new CEO to run this, and so part of the success is correctly matching you with a business model that helps, because you're green behind the ears, right?
Harder to break
Exactly.
business, maybe.
Yeah. Which I absolutely love that model, and that's essentially what we're hunting as an independent sponsor. But if I wanted to deviate from that and do different kind of business, I think I have that freedom as an independent sponsor, where it becomes a harder sell as a searcher.
The independent sponsor model economics and traditional search fund economics actually aren't that dissimilar, at least when it comes down to carry, which call it 20 to 30. Fair to say?
I think so. Yeah.
Yeah. It's actually kind of striking how similar they are. But obviously, right, in the search model, you're stepping in as operator. Now, you had told us, Chandos, that you actually liked operations. Right. And so there is a world where you go back and do a traditional search fund again, to go in and be the primary operator, the CEO of the business, but you opted not to. So square that circle.
Yeah. So, the reason why I did a search rather than joining one of the big PE shops, is I enjoy being an entrepreneur, being hands-on, being an operator, and not losing the connection you have with the business itself. And for that business we bought last year, today I was in a conversation with the CEO talking, getting in the weeds on sales and marketing strategy for next quarter. And like that part I really enjoy. And being removed from that and managing the business just from like an Excel spreadsheet wasn't really the interest. I think as an independent sponsor, you still get to be very hands-on, even though you have a skilled management team there managing the company day to day.
Well, actually, when you put it like that, it's kind of a sweet spot. First of all, as an independent sponsor, you can kind of flex. You can be more or less operational, although I guess private equity proper would also say that about themselves.
Yeah.
But maybe it's more true in independent sponsor land, where you're smaller as an independent sponsor group. You're closer to the businesses, probably closer to management, and less spreadsheet oriented. But anyway, you can flex up or down in terms of how operationally involved you want to be. But yeah. So not the primary operator, but also not as distant or removed as you put it. I'd never actually heard the sponsor model put that way, but it makes a lot of sense. Let's turn back now to your favorite industry, from 3-year-old to search funder to now independent sponsor. You keep going back to the well or the garbage truck, as the case might be.
Yeah.
Tell us really why it is that this industry is such a promising one in your eyes.
Yeah, one man's trash is another man's treasure, I guess.
Yeah, there it is.
Right?
Thank you.
I had to throw that out here.
Yeah.
From an industry, what's interesting is, whether you're rich or you're poor, we're booming or you're busting, we're always generating trash, right? So it just keeps coming. And the service itself is truly a reoccurring monthly revenue model. So those two things I like a lot. The industry as we know it was really shaped in the late 80s, early 90s through a lot of new regulation that kind of came sweeping in during that period. And what that did is it spurred a lot of these entrepreneurs at that time to go create these interesting businesses. And now those entrepreneurs are in their 60s and 70s looking to retire. Waste is not a sexy business, and so their son or daughter doesn't want to take it over. And so there's this really interesting generational change that's happening. And then there's also kind of a feel-good piece to it, which is, in the U.S. we recycle less than 40% of the waste we generate. And if you compare that to Europe, developed nations in Asia, some of these countries like Germany are pushing 60+% recycling rates. We're just really behind the ball. Like it's pretty pathetic, to be honest, in terms of what we do as a nation. We're not a leader in this space. And so I think that to me has also a place where, can we make an impact and do something better while also making money for myself and for my investors and creating a good environment for our employees and good service for our customers and kind of bridge all that together. It becomes really interesting.
Tell us specifically within waste management what your search business was, what subcategory it was, and then what you are doing today in waste management.
Yeah. So started my search in 2015 and decided that the waste would be the first industry I focus on, and hopefully I could be successful there. And when I dug in, I really started to understand that this industry is broken into a lot of different verticals. In my search process, I think we broke it into 17 different verticals. Things like residential and commercial waste, kind of as a generalist almost, to specialty things like medical waste, hazardous, biohazard, liquid, porta potty, like construction. And I came across tires. And up to that point, I didn't even kind of think about it as a waste stream, but it's a very large waste stream. In the U.S., we essentially, the stat is it's one tire per person per year. So there's 270 plus million tires a year that have to get disposed of. And if you think about it logically, every 3 to 4 years, you change your 4 tires. So that's kind of roughly how it plays out. So in the tire space, you get paid to take the tires away from the generators of the waste. And then if you can figure out what to do with it and how you either resell it or process it into some kind of recycled rubber, you also get to sell it on the back end too. So the economics and the dynamics of it were pretty interesting. 3 months into my search, I came across this first company and got it under LOI and felt like an absolute rock star because, I was getting a deal under LOI my first 3 months and being green behind the ears. I didn't have a good LOI. I didn't take in, the stakeholders there is the seller, it's your investors and it's yourself. Right. And getting to an LOI that addressed that, it just kind of blew up on me. Stayed in touch. A year went by and re-engaged. And a few months later, we closed. So we closed on March 13, 2017.
Anything to learn there from version 1.0 of your LOI to version 2.0 of your LOI that actually got you across?
So specific to that, there were kind of 3 components that sort of blew up the deal the first time around. One was Regulation. There's a lot of regulation in this space, and I don't think I initially did a good job articulating and understanding and appreciating it. And what eventually evolved is understanding that this regulation is actually a good thing. It's a barriers to entry. But I don't think I did a good job satisfying and providing that explanation to our investor group. So there was concern around regulation, capital intensity. You own a fleet, you own recycling plants. So understanding what that means and how that impacts free cash flow. And at the end of the day, we're buying free cash flow with this kind of business, not EBITDA. So understanding that, and then real estate. Like one of the assets we bought here was a 360-acre landfill. So we were bought, we in a lot of our situations, including on this first deal, we own the real estate, we own the landfill. So, our investor dollars is really chasing EBITDA, and it's a different risk profile than chasing real estate. So understanding how to kind of marry that and correctly price that and correctly fund for that was also a dynamic that caused it to initially blow up. But
so it was your investors who blew it up or vetoed the deal. And then you accounted for these three elements that you just talked about in your second shot, and your seller was still amenable and you got it done.
Yeah. I mean, it was a mixture of investors and the seller. We had to reprice for the real estate, and that is always a really difficult conversation with a seller. And also reprice for the capital intensity. And so the second time around, I did a better job setting the right expectations with the seller.
And Chandos, when you said that this type of business, you're buying cash flow, free cash flow, not EBITDA, you mean because it's CapEx intensive?
That's right.
Well,
yeah.
Okay. Just clarifying.
Yeah.
You said there that it's really difficult to have a repricing conversation with a seller. This is something a lot of the listeners can relate to. What are your best practices in managing such situations?
I think if the seller trusts you, and over the course of before you have a renegotiation, building a lot of equity with the seller, I think that's important. That goes a long way.
You mean goodwill?
Goodwill. Here. Yeah, and I think also being transparent up front that, look, I'm paying you X, and that is based on Y of free cash flow or EBITDA that you're delivering. And we're going to have to go through a quality of earnings process and think things through from a gap. And if there's, project revenue, a WIP, and all these things kind of evolve and depending on what the accountants say, if it's plus or minus a small percentage, fine. But if your EBITDA is drastically different than our expectation going into it, then we have to have a real conversation and being upfront about that. Doesn't mean it kills the deal. Doesn't mean we walk away, but we have to sit down, and if your EBITDA is different, then our deal needs to be slightly different.
If you contrast a situation where you feel nervous about repricing versus a situation where you feel it's just purely merited and they're probably gonna accept it because they understand, what do those two scenarios look like if you compare them to each other? Does that even make sense, my question?
Yeah. So I try to be sensitive to the fact that going in, I don't want to retrade the deal. That's maybe some people's approaches. So there's obviously kind of the merit base on looking at the exact numbers and say you're paying 5 times and whether EBITDA is 1.8 or 2.2, having a multiple on that, right?
Right.
But there's also the emotional piece to it, and in the grand scheme of things, if we paid $100,000 more, it doesn't really change our outcome. It drastically changes the seller's view on whether or not you're retrading it. So there's definitely some give and take around that for sure.
Let's take a step back to 2015 or when did you actually acquire this company? So you started searching in 2015, and then this company that you'd started negotiating with pretty much right out of the gate in your search. When did you close the deal? And tell us a little bit about the journey.
Yeah. So, so as I mentioned, 3 months in, we came across this business, got it under LOI. LOI blew up. So I continued searching, started looking in other verticals within the waste space. Stayed close, checked in every couple months. This particular seller was in Portland, Oregon. So, I'd make a trip up to the Pacific Northwest and say, I'm driving by, let's go grab coffee, and stayed interested, and stayed went and toured their plant throughout this kind of period. And essentially reestablished the trust, got the deal back, under LOI in late 2016. And ended up closing March 13th, 2017. And we actually closed on 3 businesses. There was common ownership between 2 different owners, but it was 3 different operations, 3 different set of books, 3 different company brands, and closed on those 3 on the 17th, the 13th of.
Sorry, and these were multiple different deals, or was it effectively the same seller but multiple entities?
2 different sellers that had 2 of the sellers shared in 2 of the entities, and 1 seller solely owned a different entity.
All right. So at this point, you're negotiating multiple deals, and you're seeing the opportunity to start consolidating right out of the gate.
That's right. Yeah.
And as a first-time searcher in this case, did that complicate the narrative to investors, or did it make them more excited?
The fact that they were kind of common ownership across the entities, it removed the risks of that. Like, hey, are we doing 3 separate deals, or is this just one? Collectively, it brought our EBITDA just under $2 million. So it size-wise became interesting. There was obviously some risk that we're negotiating 3 different purchase agreements. But it wasn't like there wasn't tension in our process with investors because of it.
Chandos, how did you think about, or did you, because you were a first-time searcher, but how did you think about where this industry was in its consolidation cycle? Because you had said to us that actually it was late innings, right? Not the best time to invest. So how did you think about that?
Yeah. So, we've identified that there was this 800-pound gorilla that did a really good job consolidating on the East Coast and Midwest, and hasn't quite really reached the West Coast. And in our diligence, we identified throughout the West Coast there were still quite a few mom and pop operators that if we wanted to, we could add on at a later date. So we knew that they weren't actively in our territory, and maybe one day they would be, or maybe one day they would want to buy our territory by buying us out. But they weren't an initial threat. So we got comfortable with it. Because of those factors. Also, when we went out and did market research and spoke with customers, we also realized that they probably weren't the best from a quality of service perspective, and if we were to compete, if we competed on quality of service, we would have an advantage there, and we could probably be a little more agile, a little more nimble. Just because we weren't this 800-pound gorilla.
Mm-hmm. And that's what you proceeded to do?
Yep, that's right.
Steal customers?
Stealing customers.
It's okay. We can find a euphemism if you're uncomfortable with that, but effectively.
I love taking my competitors' customers. No, the fact is I really enjoy winning. And there's and if you can take someone's steal their customers.
Okay.
So
the other thing you told us when you got into the industry that I think you didn't perceive from the outside was the price inelasticity. So you found that you could raise prices without much of a peep from your customers. It was one of those. It was one of those businesses where essential to your customer, but low on the P&L. So they're not a big cost to them. Right where, that's the kind of the perfect, the sweet spot. And there you sat, and in fact, were able to raise prices very successfully through your ownership, through your hold period, right?
Yeah. So that's correct. So we one thing we wanted to evolve into is being considered the gold standard in the industry for quality of service. And so as we sat down and really started to figure out what KPIs we wanted to manage this business with, quality of service was one of just a couple. And we end up going to the customers and saying, well, how do you define the best quality of service? And we allowed them to define what it meant rather than us trying to figure out what we thought it should mean. And that became a guiding core, really a core KPI in our business model, was making sure we delivered the best quality of service as possible. And to your point, we really underappreciated the pricing and elasticity that was in this space. And what we learned over time was as long as we delivered on high quality of service, there was less sensitivity to pricing, and we could roll out, low double-digit price increases, and have very little turnover.
The quality of service aspect there, you so often hear small business owners will say, we have the best quality of service. I hear it a lot, even in pretty commoditized industries where it's hard to differentiate. They will proclaim they have the best quality, which is honestly hard to provide, especially if you're competing against an 800-pound gorilla, because they can invest in marketing and branding, but more crucially in training, technology, back office support, and also have procurement advantages with economies of scale. And so as you compete against someone so big on quality of service, is this just something you say, or how can you gauge that you're ahead of them on that?
Yeah, so we definitely knew that our large competitor could outspend us, to the points you made. So and this isn't rocket science. Like our customers' definition of good quality of service was, if we said we were going to be there on Tuesday, we showed up on Tuesday. And we didn't show up on Wednesday or Monday. We showed up on Tuesday. And when we showed up, we picked up all of our tires. We didn't leave tires behind. Right. So it wasn't this complicated formula to figure out quality of service. And I think because of our size, we were able to stay in tune with what was happening locally and really measure it in real time and be the customer's partner so we could deliver on that promise. I think at some point, our larger competitor couldn't be in all places at all the time, and lost touch sometimes in certain markets because they had a manager turnover or driver short strike or something happened, and they just couldn't deliver on that quality of service promise that they made. And you know what? That's when we won customers. It wasn't because we came in and we underpriced. We made sure that our competitors' customers knew that we were around. And the moment that our customers having a driver issue and our competitors having a driver issue and can't come service you, then we would be there to show up and we would turn into your partner.
Defining the KPIs, is that an exercise that every business buyer needs to go through upfront, or shouldn't that already, to some extent, be existing with a business that is ongoing? What's your view on that?
Yeah, I mean, this is my favorite topic. I could probably spend all day talking about it. I would say in this lower middle market, small business world, I have not once come across a business that has a good set of KPIs defined for it. And I think if I could contribute value creation, not just in growing the business, but also for our investors, to just one thing or one primary thing, it would be the fact that we figured out the right KPIs for this business. And then it got ingrained into our culture. It was what we talked about every single day. It's what we compensated people on. It was what I was compensated on. And over our entire hold period, it was the primary conversation.
You wanted to talk all day about this, so give us a little bit more here.
Yeah.
Like, what does that actually mean? Because looking at, the volume, for instance, of customers you've serviced, right?
Yeah.
These are obvious things that I'm sure they did prior to you closing. So why is there this need for reinvention when Chandos walks into the room?
So I don't know if it was this reinvention. And I'll tell you, it didn't come easy. It was a lot of hard work. And it required continuous reinforcement, and re-education on it. So, I worked really close with David Dodson, who's in the search community, and probably for 6 months, every Saturday we got on a call for 15 minutes to 30 minutes talking and working through this problem, and identifying the right KPIs wasn't that difficult. Like we knew that revenue per hour, because we're a route business, a revenue per hour metric probably had a very powerful impact. And what we found out is, if my drivers were picking up 100 tires per hour, if I could figure out how to just get them to pick up one more tire per hour, that small incremental improvement would generate an extra $250,000 of EBITDA for us. We obviously, as we touched on earlier, we knew that quality of service was critical. We wanted to be the leader, the gold standard. And then in our plants, there was also a recycling recovery rate metric that also drove a very nice, had a very strong impact to margin. And so figuring that out was something we really learned in the first couple of weeks when we started this exercise. What was hard is actually deploying it. I remember very clearly when we figured out this revenue per hour metric as our KPI. I'd go to my managers and say, here's what it is. Here's how we measure it. High five, let's get started. And like a month would go by and there's just no impact. And no one cared, no one understood it. It was too hard to calculate. And what I figured out is, unless the boots on the ground, and in this situation, our drivers really understood it, embraced it, and could calculate it in real time without having some complicated Excel formula, it was never going to get adopted. And so that was the hard part, was really figuring out, how do I motivate the blue collar workforce to care about this? How do I bring in compensation? How do I bring in competition? How do I bring in discipline, and kind of marry those three things together? So whenever I showed up, at the end of our hold, we had about 14 locations. But, when I do a road tour and show up, the first conversation was, hey, how was your tire per hour yesterday? And if the driver couldn't tell me what his tire per hour metric was yesterday, that he picked up on average 102 tires an hour, then I knew that I either had a problem with my driver or a problem with my site manager, but there was a problem somewhere that we had to address, because my driver needed to know what his tire per hour was.
And Chandos, this is like coming up with the good KPIs itself can be a challenge. Although it sounds like it was not so challenging in this case, but then having everybody embrace them, it is so challenging. Mm-hmm. So in this case, like, let's take the tires per hour. Was it basically in simplifying it? I mean, tires per hour, that's 3 syllables, pretty easy for everybody to remember. And then reinforcing, reiterating, repeating, sort of kind of approach. What did you because you just said you figured out how to get everybody to internalize it. On that particular KPI, how did you do that? It sounds like it was just repeating it, really.
Yeah. So it started off as a revenue per hour, which is really what it stayed at. But the drivers didn't know or care about revenue. It was hard to explain. So we evolved it into a tire per hour. So we turned it in something that they could relate to, that they were very much in control of, right? And then the question becomes, well, who cares? And so what we ended up doing is evolving a compensation incentive plan where it wasn't just beer money at the end of the week. Like these, our average driver was probably making as a base wage close to 80, call it 80 grand a year. If they were hitting their KPI as an individual contributor to the business, they were making, six figures, 125. I think our top performing driver was making over 130,000 a year. So it was material. It was very meaningful, right? It was the difference of whether or not they could go buy a house or not. And so that became a moment where people cared about it, right?
Yeah.
And
How powerful.
Yeah. And then where it got really interesting, where it really turbocharged, was we got to a point where we're able to publish and share this data in near real time. So when drivers would show up in the morning, they would see that, they had their own results they knew they could calculate, but they could also see how all their peers performed and see where they were ranked within the company. And the top 10% of the drivers made a lot of money, and the bottom 10%, well, guess what? They would go on probation and get either work their way to figure out how to improve or work their way out because they just weren't top performers. And so what it did is it created this high performance culture amongst the drivers. And the top performers wanted to be around top performers. And it kind of started breeding this kind of snowball effect where, we ended up having really amazing talent at a driver level. Mm-hmm. And when it really started to click, it wasn't us pushing ideas down. Of course, in the beginning we said, okay, well, how do we optimize routes? And that would improve the tires per hour, right? But then it was in our driver meetings, they would present us ideas, and I remember one of the drivers was like, we spend 20 minutes a day filling up our trucks at the gas station. Can you just have someone fill up our trucks at night so we don't have to worry about it? And it was like such a basic, simple, like it was a no-brainer idea. And all of a sudden we just gave 20 minutes back to our drivers to go pick up more tires. Those were, so it was like these bite-sized ideas our drivers pushed up.
This is one of those that sound so obvious now after the fact, but when you're in it or before it, it's hard to conceive the impact of having one KPI that you also compensate so heavily and the impact of that. How do you even know about this or learn about it or position yourself to take advantage of such an incredible organic growth driver?
David Dodson.
Yeah, exactly. I was fortunate enough to have David Dodson as a mentor. And that was, that was the 6 months every Saturday. My Saturday morning was talking to David Dodson about this. So it was about having essentially a coach, a mentor that's done this. And, he's been involved in other waste and route related businesses. So he helped me shortcut the process. And so it was part of me being, just listening and absorbing and then shamelessly borrowing and copying his ideas. So it was David. I'd also have to give John O'Connell, who was CEO that ran Wind River Environmental, a lot of credit as well. So the two of them, I just took their idea and did my best to execute. And then when I failed, I took my notes, and instead of getting my ego hurt, I took my notes back to David and John and said, hey, here's where it's not working, and let's kind of debrief and evolve the process.
And so if you extend that to other deals in the independent sponsor ecosystem, is the solution to ensure you have a strong board, a strong set of advisors who have been there before with this exact type of business?
For me, the short answer is yes. Surrounding yourself with either a board or someone on the cap table that, that essentially has forgotten more than you'll ever learn in this particular, subject matter. And to give a couple examples, like in the carbon monoxide. So last year we bought a business that provides carbon monoxide monitoring for parking garages. So if you own an apartment building and you have an underground parking garage or an office building with a semi-enclosed garage, in most states you have to be in compliance, you have to monitor the CO so you don't poison people. So this company installs the system and then on an annual basis does the reoccurring calibration and maintenance. With that business, as part of our board, it's on the fringe of fire, life, and safety. And we knew that, we know that it very much, the characteristics follow that industry. So on our board is a gentleman that has that was an operator, has a lot of success in selling a fire, life, and safety business, and is a contributor to that company.
And what kind of involvement would you expect from board members? Because most of them will show up quarterly. Most of them are not paid beyond their investment in the company. But how should we think about that?
And Chandos, your example of your weekly calls, I guess, with David, that's a lot more than board members typically envision themselves signing up for.
Maybe I'm demanding. No, I think board composition and as you construct it is really important, and should be very very thoughtful and thought out. It's not about just filling a seat with your largest investor, which also might be very important too. But having being upfront about the time commitment demand that you want to have. And really turning your board into a set of really into mentors, I think is if you figure that out, I think it helps you or your CEO quite a bit.
One of the traditional search fund virtues is the exposure that a young first-time CEO like you will have to experience smart investors. At least that's the value prop, the pitch of the search fund, and it happens to varying degrees. But just to call out, it sounds like you really got your money's worth, and that model, that claimed model of the traditional search fund, really played out in your case. Yeah. So just an observation.
Yeah, and I think that to that point, Will, as a first-time CEO, that really helped develop me. I give a tremendous amount of credit to the community, my board, and to help develop me as a CEO.
But there's a push-pull effect here, right? Because you can solicit their input and advice in weekly calls versus they can proffer their experience and expertise. And how do you kind of navigate that balance?
I think for me, it takes a little time, but what I learned was certain of these investors gravitate to different kinds of topics where you could tell their eyes light up. Like when I talk about KPIs, I knew that David Dotson's eyes lit up. So I naturally then gravitated and realized that this is an area he really enjoys. So let me tap into that, and that way it's not a workload. Instead, he wants to spend Saturday morning with me, and so figuring out what they get excited about, your board members, your investors, and then using that excitement to help teach you or learn from. I think that was that was the part where it started to click.
So taking a step back here, you did 14 add-on acquisitions. You have talked about how you increased prices. You have talked about how you identified tires per hour as a key KPI. And what other key KPI? I'm just
a KKPI.
Yeah. Anyway, what other factors were at play in generating a 5x net MOIC? And can you talk to us a little bit about how you attribute that total return across these growth drivers?
Yeah. High level, we came into this roughly around 2 million EBITDA. By the time we sold, we more than quadrupled EBITDA. I would say less than 25% of that growth came from the add-on acquisitions. And the remaining chunk of that growth came from organic initiatives. And within that organic initiatives, it was margin expansion with things like this tire per hour KPI. It was putting a tremendous amount of energy around quality of service, which then allowed us to do price increases and allowed us to go win new customers where our competitors were failing. And I think so that concentrated focus around those two KPIs were a huge factor to our overall success of driving value back to our investors. And then of course there was also a really interesting arbitrage. We were buying at an average of about 4.5 times EBITDA. And we sold for north of 8x, and that arbitrage on the multiple was really driven because we figured out how to professionalize this business, how to scale it, how to grow it, how to pay attention to what mattered the most to our customers, and how by doing that it improved our bottom line.
How has the business performed since you sold it over the last couple of years? Do you know?
Yeah, so we sold in February of 2024, and I think so during our hold period, during our operations, one of there was an interesting moment of change where a couple of years before we sold, our bit larger competitor was not doing a great job with service for Walmart, and they had the national service for Walmart. So Walmart said, "Fine, we'll just take this out to bid." And we ended up at that point we grew ourselves into a super kind of regional service provider servicing the Rockies West, and we ended up winning Walmart in multiple states. Which was also a very large organic growth for us, and probably a whole nother podcast on how to manage a beast of a client like Walmart. But that I think was a wake up moment for our larger competitor, and then they started investing a lot of money into quality of service. So post closing, they were our buyer.
And to be clear, this is the 800-pound gorilla,
that's
the
right,
aforementioned gorilla. Yeah.
Yeah. So they acquired us. And I think they've been doing a great job. I think a lot of the high performance culture that we spent 7 years building, they continued and they appreciated. And I think they're doing a really good job. Every once in a while I check in on the customers, and they all seem to be happy, which is good. And more importantly, the managers that we developed, that we spent a lot of time turning in from site managers into regional GMs, teaching them how to manage people, how to manage a P&L. The bulk of our managers and our drivers and our plant operators, they're all still there.
Chandos, there are two other patterns that I notice in the story. I wonder if they're generalizable. The first is how you explained your acquirer, who are the gorilla as you're going into this, was not yet in your geography. So there was this, market share geography that you could take, with the idea, though, that they're expansionist, that they probably will want to just go ahead and take, claim the entire continental 48 at some point. So you position yourself in their eventual sites, right? Is that seemed to have played out. So, sorry, and just the other pattern is, we were talking about it before, and you just mentioned it again. It's often possible to outcompete a big Goliath of an incumbent because their scale actually means that their service quality has degraded, and you can go in there and white glove it and steal share that way. gets their attention again, and then maybe they want to acquire you for that reason, whatever, maybe not. Respond to both of those kind of patterns.
So I think you're right on both. The first pattern of being kind of an important piece of the puzzle in the 800-pound gorilla's overall footprint destiny.
Yeah, exactly.
I think it's we knew that's what we were building. Coincidentally, it wasn't why we were building it, but we knew that let's take full advantage and build it out where it made sense. And that was an important factor for the acquirer was, they could overnight set up shop and have a dominating footprint in this footprint now, right? In this market. I think you'll probably see in a lot of service industries, the second point you were making on just being a smaller operator, we can be more nimble and provide a more responsive white glove treatment experience for the local customer. Therefore making us a better competitor. I think that definitely played out here. And I think that's repeatable. Yeah.
So Chandos, at the top of the hour here, you talked to us a little bit about why you like the waste management space, and in particular the tire waste management space. How can others identify verticals that kind of have these favorable dynamics? You talked about, it's an unsophisticated industry here, still very fragmented, at least on the West Coast, not yet driven by PE money. There is a silver tsunami going on in your industry. So how do you identify new verticals like that? Or have they all been taken by now?
So I'll give you a story. I thought commercial and residential waste has been played out, right? You have Waste Management, Connections, Republic. These guys have done a phenomenal job. These are large consolidators that have done a great job building out the industry. One of our operating partners last year challenged us to say, well, wait a second, there's still, we should take this space serious, because these larger consolidators, they've moved up the chain, and now deals that are sub 5 million EBITDA are falling off their radar. And so if we could have a model where we were looking at these businesses that created these independent operators that created a good service footprint, they're doing $1 million or so of EBITDA. It's not getting picked up by the big guys, and we can bring a handful of those together. And I was pretty skeptical. And then I just got out on the street and started talking to, meeting these sellers, and it really seemed like the case. Which is the next platform we're building is focused on commercial and residential waste, and in a region where it's less competitive with the big guys in it, and I think we're going to build out a really interesting platform. So I guess to your question, Nicholas, I would challenge the thought process that a market's been played out, because as it starts to get heavy interest, then all of a sudden the interest starts to move back up the value chain, where you're looking at larger deals, and there's just so many smaller deals to be had. So.
And you've been kind enough to invite Minds Capital into the loop here to review that deal that you're looking at currently. And based on this call, I'll tell you I'm at least not less excited about it. It's going to be interesting to spend more time on it.
David, Nicholas, I thought you guys were committed. I penciled you in for $2
million. Will David Dodson be on the board?
You know what? TBD. But I hope so. Also, I would share too, back to your question, Will, about kind of the merge between going from search to independent sponsor. To use that carbon monoxide business we bought last year as an example. With that business, we had a seller looking to retire. And so we knew we had to put together a management team. And when my partner and I sat down to figure out who should, what do we want from a CEO? And really our scorecard said, we wanted a searcher and the attributes of a searcher and someone with either HVAC or fire life and safety experience. Like that's what it really boiled down to, were those two things. And so I went out to the search community, and we ended up raising that deal with the search community. And I give credit to Todd Tracy at Search Fund Partners, but I went to Todd and said, here's my scorecard. Do you know any searchers that are at the end of their search, and for whatever reason, they were not successful in the search, but they are going to be a phenomenal operator? And he said, look, I know this guy, Corey, you need to call him. And that's who ended up being our CEO, was a searcher at the end of the search. And it was a perfect fit for what we were doing. It was a perfect business for the search community. And we ended up funding the entire deal. The entire cap table is a set of traditional search investors.
Wow.
Yeah.
And Chandos, why did you have that criterion that they be a searcher as opposed to, say, an executive, just a mid-career executive?
Mm-hmm. So as you know, the searchers are a special breed, where they're young and ambitious, and they are usually a very smart individual that is willing to work exceptionally hard and apply their intellectual ability to grinding through to figure out, how do you build this company, right? And that kind of grit is I think difficult to find. And someone who's, and so that's what we wanted, was someone that can just roll up their sleeves here.
Well, also, if they're at the end of their search, you can talk to the investors, and who now have seen this would-be CEO conduct their search for 2 years, and how they've done so, and how well they've done so or not. So there's some built-in vetting if you can go to search investors, and they'll be able to give you a report.
Yeah, I mean, that's a beautiful part of the search model for the investor's perspective, right? You have this 6 to 24 month timeline working with the searcher before you actually then make your investment in the company.
Yeah.
So you build that rapport and that trust, right? And so by Todd Tracy working with this searcher, he knew that this person was going to be a really good CEO regardless of the outcome of their search. So anyways, as an independent sponsor, we still very much closely tie into the search community and tap into it for CEO resources, for capital resources, but more importantly, I think for guidance and advisors and mentors.
Chandos, we got to let you go here, but one last question on this contrast or your evolution from searcher to sponsor. We heard at the top kind of the mechanically how it's different, and the searcher as operator, independent sponsor a little bit more removed. But just speak more kind of in the motion of your day to day, and how that's now different as a sponsor. And I'll just call out two things: you're less operationally involved, way less, obviously, and so the nature of your work is quite different. So elaborate on that, and then also you've got one working on two portfolio companies. So now your attention is split. I don't mean for that to sound negative, but now your attention is shared by two companies rather than your full focus being on the sole search business from your first chapter. So attention splitting and how the nature of your day is different.
When I was CEO of the search business, of the tire business, I think my day-to-day, over 80% of the day-to-day was about thinking through how I manage people. Do I have the right team? How do I motivate? What's our punch list for next quarter? How do we execute on that this quarter? It was very much a human resource job for a huge chunk of my time, and which some of that I enjoyed and some of I did not, but realized it was necessary regardless. In this role as an independent sponsor, I spend probably half of my time thinking through with my investor hat, is this the right investment? Is this the right company? What's really the opportunity here? What am I missing? How do we grow this? And then I spend the other half of my time with the team, but now the team is my partner or our CEOs, and thinking through, strategically, what are we doing next quarter? So I'm still having that human resource role, but it's very much kind of a one step back, and it's a strategic conversation rather than the tactical in the weeds. Let's call the controller and figure out this one particular data point, right? So that's probably how it's evolved. Yeah.
And you were right that you prefer that. You found.
What I'm finding so far is I'm very much reflecting on the experience I gained as a searcher for that, and using that as part of my kind of pattern recognition, decision making process, guidance, advice going forward with our CEOs. So for me, I don't think being a searcher was extremely valuable and taught me a lot, and that experience is, I think, helping me be a better independent sponsor.
Great. And on this deal that you're working on now, so not a done deal, but you'll be sharing your attention between two businesses. Mm-hmm. Anything to say there versus having one be your sole focus? Or
yeah. So I think part of it is building the right team, right? So the day-to-day is not shared. The day-to-day management of our waste platform is going to be a CEO we put in place. I think my time split between the two, what I've seen on how to share my time here is usually there's one problem to solve. And today I'm going to spend my entire day helping our CEO at the carbon monoxide business solve that one problem. And that's my contribution today. And tomorrow I'm going to sit down with our CEO on the waste business and help them spend the day solving that one problem that they have. And the likelihood of having 14 problems at once in 1 week is unlikely. So I allocate my time based on the urgency of the value creation of solving that one problem.
Well, it sounds like it allows you to be more selective in the problem that you devote time to, as opposed to maybe being a CEO or stuff is just flying at you and you gotta it's more responsive maybe than proactive problem solving.
Definitely. I'm more able to tune out the noise now, and put a heavier concentration of coming up with a better solution, because I can. Whereas in the CEO, you're right, you're hit from 1,000 different directions all day long.
Yeah.
Thank you, Chandos. Well, before you closed it out, I was left a little confused by a statement you made earlier here. Tires per hour. You said it was 3 syllables. Well, I'm not a native English speaker, but isn't that 5 syllables? 3 words.
So we shortened it to TPH, which is
tires per hour. No, that's 3 syllables.
Okay, well, I need to look it up, I guess.
Yeah. And wait, Chandos, you be the tiebreaker here. It's 3 syllables, right? Tires, 1 syllable. Per, definitely 1 syllable. Hour. Is hour 2 syllables? I say it's
tires
so
and hours are 2 each. Yeah.
Yeah. It depends on how you just want to pronounce it.
Well, what would you say?
I always say tires. I go hard on the R. So tires.
He's coming in on my side. He's coming in on my side.
Per hour. Interesting. Tires per hour.
Yeah.
Thank you.
The Norwegian corrects the American, although I'm not sure. I'm not ready to concede. Chandos Mahon, thank you for joining us. Thanks for coming on the podcast. Thanks for sending us your latest deal. And really, really interesting to hear about your evolution. We're excited to perhaps participate going forward. So thanks for coming on.
I appreciate you having me, and looking forward to having you part of this.
Great. Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.